Week in review. This past week, the financial market experienced significant fluctuations. Investors redirected their attention from the well-known technology sector to sectors that are more stable and less affected by interest rate changes. This is often referred to as defensive sectors. These sectors are anticipated to gain from the possible upcoming reductions in interest rates later this year and a decelerating economy. The top 10 corporations within the S&P 500 are predominantly composed of large technology companies, which constitute an impressive 37% of the index's total value. Therefore, it was not unexpected that when these technology stocks suffered losses, the overall performance of the S&P 500 also declined. The index concluded the week with a decrease of 1.97%, about 2%, and this is the poorest performing week since April of this year. Despite some positive trends in the wider market, the significant sell-off in these major technology stocks had a substantial impact on the S&P 500 this past week. Now, this week, moving forward, the financial markets will experience a slight pause from the regular influx of economic data. Nonetheless, the limited number of reports that will be published are of considerable importance. We will receive the initial estimates for the PMI, which is the Purchasing Managers Index surveys for both services and manufacturing sectors, which provide us an early indication of the economic environment. These figures will prepare us for the upcoming release of the GDP, which is the gross domestic product data for the second quarter. However, the focal point will be on the inflation report. This Friday, the PCE, or Personal Consumption Expenditures Price Index for June, is scheduled for its release. Should this report indicate a continued deceleration in inflation, it might bolster the likelihood of a reduction in interest rates come this September. See you guys next week.